let's take a dive into subsequent events here. Well, a subsequent event is an event that occurs between the balance sheet date and the date of financial statement issuance. Think of it like a nice catch-all where you've got a couple months, weeks, whatever it may be, until you issue the financial statements, and you can always go back if something happens in that period and adjust for it. So when are the financial statements considered issued? These will be questions that you might see on the test. Is when are they considered issued? Well, when they comply with US GAAP and all necessary approvals have been obtained and they're ready to go, right? And then when they are readily available to the users of the financial statements, so the investors and creditors, if the financial statements comply with US GAAP and they've gotten approval from the necessary organizations, but they've only been distributed to like 2 or 3 people, that's not considered readily available. So these would not be considered issued. There are 2 treatments for these events. For subsequent events, now this is in addition to doing nothing, because if it's not really a subsequent event or if it's immaterial, you're not going to do anything. But if there's a subsequent event you need to take action on, you're going to record the journal entry and disclose it, or just disclose it. Because if you're going to record a journal entry, that means it affects the year that just passed, and then you'll disclose it as well. But if you're going to disclose it, that just means it doesn't affect the prior year, and you just want to talk about it because it's important enough that the users of the financial statements should know about it. Again, the subsequent event evaluation period, just a great opportunity to reevaluate what's going on and to see if you need to elaborate on anything, because we want to paint a clear picture for the users of the financial statements, making sure that they are knowledgeable about everything they need to do to make a decision. Let's take a look at some examples here. So recording a journal entry and disclosing. So when you recognize a subsequent event, you're adjusting the financials with numbers. Recognizing, recording, remember that. So you record something when you recognize it. This would be due to the event affecting the relevant year's numbers. So all these examples, we're going to use year 1, and then the subsequent event period, let's say, is up until April 15th, year 2. So if the event affects year 2's numbers, then it would be recognized through journal entries next year in year 2. So here are 2 commonly recognized subsequent events. We've talked about this a lot throughout different modules here, so bear with me. Great example, and it'll be free points on the test once you have it down nice and well. So settlement of litigation. Let's say that a company was sued in year 1. The company's year-end financial statement date is 12/31 year 1. The lawsuit was settled on February 12th, year 2. Now, we have a planned issuance date, right? And that says it's March 15th, year 2. I mean, that being said, the questions probably should give you one, but if they didn't, generally they're going to use March 15th or April 15th. So this would be a valid date, right? Like this would be a valid date that you would do something about. Since the litigation affects year 1's numbers and the company knows how much to account for, so it's estimatable, you have a number, and it affects year 1's numbers, before the financials are issued, the company can accrue a liability through entering a journal entry to year 1's numbers. That is a classic standard example of something you might see, and you should be definitely prepared to address on the test. What about a loss on an uncollectible receivable? So in this case, let's say we use the same dates as a litigation example. The company has an accounts receivable balance of $1 million at the end of year 1. On February 12th, year 2, a major customer announces a bankruptcy and that it will not be able to pay its vendors. So that's us. The amount owed to the company, to us, is $250,000. Since this event was discovered after the balance sheet date, so after 12/31 year 1, and before the issuance date of March 15th, year 2, it's considered a subsequent event. As such, we would recognize the $250,000 as a journal entry and reduce year 1's AR balance to $750,000. It was a year 1 event that we finally figured out in year 2 in the subsequent event evaluation period. So we need to accurately update to reflect the year 1 numbers.